Good morning. Welcome to my YouTube channel on synthetics. I'm your host, WindFX. So I'll be starting out with what we have here, and our two previous videos on time frames and candlesticks was made by one of us, and you can do well to check them out because it forms the basis of one of the things I'll be, some, or few, or most of the things I'll be talking about. Right. So let's dive into the video. We'll be looking at just what you may have known before, directional bias. So understanding the basics or how to pick, you know, a good directional bias, or knowing the direction of the market so so you can trade in line with it basically. So let's just have a drawing here. This is okay. We have a series of higher highs here. This is an uptrend, right? So the directional bias here shows that this is an uptrend, right? The market is trading up. And then for this series of lower highs and lower lows, this shows, right, that the market is trending down. And the directional bias is downtrend. That's just what directional bias is. So how do you know the bias of the market per time? Because of course market just don't move in a straight line, right? You can't have a market like this move, right, and then start coming down just like that. It's not possible. Do you get it? Inside this line, as it were, would be expansions and retracements, expansions, retracement, expansions, retracement, expansions, retracement, like that. That is what you know forms the movement. So how do you know that okay, the overall movement is an uptrend and the overall movement is a downtrend? If price is just moving in zigzag direction, you know, you can just have price move like this, right? Not telling a specific direction, right? But there's a way to find out per time whether market is trending down or is trending up. Okay, so let's just look at it from. I would love to go back to time frame. You have on the time frame, you have the lower time frame, the intermediate, and the higher time frame. You perform proper analysis and directional bias on the higher time frame. The higher time frame starts from H1 to D1. That's 1 hour to daily. The intermediate is the 30 minutes, while the lower time frame is, runs from 15 minutes downwards to M1, M2, M3, M5, M15. That being said, uh, when you want to find the directional bias of the market, you don't use the lower time frame, you don't use the intermediate, you use the higher time frame. You start from 1 hour and above. Preferably, I advise you stay with 2 hours or 4 hours. I'm on 2 hours currently. So now let's just check the directional bias over time of this market. Now you can see from here, right? The market has been in a series of lower highs and lower lows like this. So this signifies a downtrend, right? Bias, a lower bias, like the market is trending down, right? It has been trending down for a while now. We see a range here, right? No particular direction per se, right? but still there's a direction because it's still trending down. It's breaking lows, right? Okay, so we have been trending down basically on VIX 15 1s, right? Now, how this is just the general overview of the bias, right? Now, come to think of this ranging market here that seems to be ranging, but it's not. Let's just, go closely to it. You can see, right? You have an equal, well, not really equal high, yeah, something like this. So let me use this from this point here, right? Market peaked from there, right? Equal highs, right? Right. The lowest point was this point here, and you can see how market broke that point. That's to show a change in the structure to the downside, which you can call a break of structure too, right? So if you are to understand the change in the bias, right? The continuation, you have a break of structure like this, right? You always have a break of structure, just as I've shown. Series of lower highs and lower lows, lower highs, lower lows, lower highs, lower lows, right? Markets seem to break structure to show you that it's not ranging, right? That's what I'm trying to explain. See that? That's the proof that the market is not just, stagnant, it's directional. And it's directional in the downside, to the downside, right? Just like we have here. Now, seeing this break of structure, we expect price to, so let's call this just a one wave, right? Seeing this break of structure here, or wait, let me do this. We have this, let's say it's here, yeah, so here, right? That's a break of structure. We have price retrace again and broke structure again, have we? To the downside. So that means the market is trending down. So the directional bias is a downtrend. You see that? Okay. So you have here again a retracement, right? And then a break again to the downside. Another break of structure. Right. So you can see how market keeps trending down that way. And then the recent one we have is here. After market came this point like this. Okay. From here. From here. See, so market is yet to make the next break. So that's what we're waiting for. All right. So that's one way to pick the directional bias of the market. Right. Uh, okay. So another way to pick the directional bias of the market is by drawing trend lines. Now, how do you draw a trend line? A trend line, let's say you have a downtrend this way. You connect all the eyes with it together. Make sure they are connecting. Let's assume you have just three eyes. Make sure that the first two is actually connected, right? And then you extend it. Wherever market is going to make in the future should probably come back there. You get should probably come back there and start moving again. That's how you know that the market is trending down using trend lines. And for an uptrend, the same way. Now look at this. The proof that this was trending up was that I could mark these 2 points together. Do you see? I could mark those 2 points together in the market. Can you see that? I could mark those 2 points together and extend it up. and the market came back to test it again, and see how market moved up massively, right? Came from here, did this, right? Bounced off again from here, came like this again, moved up, right? Still came back on it, because if I extend this, I'll be having this. Then moved, right? So that's it. So that's one way. That's one way of you know checking the bias of the markets. And lastly, because this video is getting, I don't want it to be more than 12-minute max. You can use the channel to check, right? You can use the channel. So the channel just works just like um, it works just like the trend line, right? So you can use it here too, sure. But I'm just looking for a perfect. Can use it here. So this is the channel. You just draw the same way you draw the trend line, and then you extend it out. You extend it out that way. It must, coincide with the top, right? So you bring it out here, bring it out there. So you are seeing that this one came out, right? You're seeing that this came out, right? Yeah. So this is called a fake out, which we'll be looking into later in maybe another series. You're not in this particular playlist series. So this is a fake out, right? This is a fake out. So the channel is correctly drawn. So don't worry about that. It's correctly drawn. So what are we saying? Now we see that this marked out the direction of the market. So let's assume from this point, market had not yet happened. From this point here, from this point to the right there, right? From here to this place where it is currently, market had not yet happened. Market would have eventually grown into it, right? So that's one way to check for directional bias of the markets. And when I teach internal and external structure, I'll be going further into how to calculate or check the directional bias using external and internal structures. So thank you for, and I hope this helps. You can do more to, check through other pairs, right? And, just check for yourself and practice. Thank you. Uh, Remain your host with FX. I'll see you in my next video. Bye for now.